In this video, we're going to talk about profiting using market cycles and market breadth. Now, there's an awful lot to unpack here. So, just as a brief, we're going to cover sector seasonal cycles. We're going to talk about presidential cycles. We're going to talk about the relationship of asset classes to each other and how they cyclically can offset each other at key points of time. At the end of this video, we're also going to talk about market breadth, including a special breadth indicator that can help you identify key market inflection points. And it's a really valuable tool for seeing what's happening next on the market. I'm pretty excited about this one. I hope you are too. Let's get started. As I mentioned, we're going to start off with seasonality. Now, seasonality is a concept that shows on average how different markets and different sectors of the markets are acting at different times of the year. I want you to understand something very important about seasonality, and that is that it's a tendency, it's not an absolute. In other words, when we talk about a certain sector that tends to go up or down at a particular time of the year, doesn't mean it happens every time. It's a tendency, so you still have to go back to your basics. But if you understand ahead of time what the tendencies are for markets and certain sectors to move at certain times of the year, you are pre-armed, ready to be watching for key breakouts and trends, as we've talked about in my past series. So let's talk about the best 6 months. Maybe some of you have heard of the best 6 months of the year versus the worst 6 months of the year. Research has shown that stock markets perform worst between May and late October, and best between basically the end of October and into May. So here's the stats, and it's quite astounding. So I really want you to pay attention here. Up to the end of 2024, $10,000 invested in the S&P in the quote unquote bad 6 months between May 6th and October 27th only grew to $10,382. Can you imagine if all you ever did was invest every May and took the money out at the end of October for, what was that, 75 years, you only made $300 for your troubles? So clearly, that's not a very good time of the year to invest most of the time from a historic point of view. Now, again, that does not mean that the markets always go down or do nothing over the summer. In fact, often they do go up, but it's the degree of pullbacks during the summer that has made this number look so bad. Now let's take a look at how $10,000 did between October, the end of October, to May. So that's the best 6 months. Your same $10,000 grew to 2.7 million. This research is provided by Brooke Thackeray, who is probably the more predominant seasonal cycle investment expert on the market today, or at least one of them. It's right up to date stuff. You can see there's a massive discrepancy between these two periods of the year. Same thing with the TSX. $10,000 has actually shrunk from 1950 to 1924. If you invested only over the summer months into the late October, you would have lost almost $4,000. That's not a very good return on investment for 74 years of investing. I'd say you would agree with that. Now, on the opposite side of it, $10,000 invested at the end of October and held to May 5th grew on the TSX to $339,000. Big difference. So you can see, again, there's definitely a tendency for markets to do better in the best 6 months. In other words, generally over the winter than they do over the summer. This is not an absolute. I'm going to repeat that again because some people go, oh yeah, well, what about this year and what about that year? Markets do go up over the summer, but they more often than not have major corrections over the summer or late fall. And that's the reason why these numbers look so bad for the summer periods. Now let's talk about sectors that are affected by seasonality. And we're going to start off with, as we said, the broad markets, which tend to do best between the end of October through to May. So I'm calling it November to April here. But there's other sectors specifically that have their own time periods that work quite well. And I'm going to actually focus on a couple of them. First is gold. And gold has a pretty reliable sector seasonality tendency. It tends to move between July and the late fall. Now, the logical reason behind this is because in East Asia culture, gold is a traditional type of wedding gift, and that's usually when they do their weddings. In fact, that is considered the wedding season for in East Indian and Asian culture. So gold being the traditional gift, the producers of gold tend to stockpile ahead of that. So it tends to have a good move between July and October. Another one that I like is energy. And this one is an extremely reliable cycle. In fact, I've been trading for 35 years and I've used this particular cycle regularly. It doesn't work every year. Remember, these are tendencies, but it's got a pretty good track record. Energy tends to move between February and May. It also moves between July and October, but its best period is between February and May. And the reason for that is, guess who the greatest users of oil in the world are? North Americans. Guess what they do during the summer? They drive a lot more, vacations, all that kind of stuff. Well, when the largest consumers of fossil fuels are bracing to do their yearly high usage season, you'll find that the energy producers are stockpiling ahead of time in lieu of that higher demand season. So energy tends to go fairly low into February and then really start to build after February. And this is, as I said, a very, very reliable cycle. So again, rather than cover each one of these sectors, I recommend you read Brooke Thackeray's book called His Investment Guides and get a more in-depth look at how these cycles work. The next cycle I want to talk about is a pretty simple one. It's the presidential cycle. Again, there's logic to it. So let's take a look at the chart. What we're doing here is we're looking at the post-election, the midterms, pre-election, and the actual election year. Now, I'm talking to you in early 2025, and you can see that we went through an election year in November of 24. Well, what usually happens is leading into the election, which is November, we get a market rising because the candidates are promising you the world and everybody's getting excited about a potential change, and the markets tend to go up. After the election, in the post-election year, which is January and on in the following year, you get the first part of the year where everybody settles down a bit. And in fact, the market can fall a bit, and it doesn't start to rise again until the latter half of the post-election year. Now, what's interesting is the midterms, and these are averages again. This is not absolutely etched in stone, but these are just tendencies that tend to happen. But in the midterms, you'll find that the markets actually, on an average, perform fairly flat. And again, tendency, not an absolute. The market starts to take off in the last quarter or so of the midterm, and then the best period for markets are the pre-election year. And that's because, let's face it, the current president is going to put his or her best foot forward and try to make themselves look good so that they can have a second term, or their predecessor in their party will get elected again. So pre-election tends to be very, very strong for the markets. And we've seen that. If you look back over the past couple of decades, you'll find that rhythm is fairly consistent. Let's now talk about the more traditional cyclical rhythm. And I've got a chart here of the commodity rhythm going way back to 1805. And the beautiful thing about this chart is I spelt rhythms wrong. So in case you guys start commenting below, you'll notice that I'm a financial analyst and not a literary arts major. It's pretty clear when you see my spelling mistakes, and I'm laughing about it right now because I just noticed I spelt it wrong. Anyways, so this is the commodity cycle going back to 1805, and you can see that it is fairly rhythmic. I would say roughly 30 to 50 years in length, and it is something that is relatively reliable. Well, this chart goes back down to about 2000, and the predictions would be that anywhere between 2030 to 2050, you'd see another cyclical peak on commodities. If you go back to about 2020 or so, you'll notice that cyclicals such as oil, gas, materials did start to catch a bid. These are long-term cycles, but it's an interesting one. What I'm really trying to talk to you, not so much about the commodity cycle, but that there is rhythm to the market in almost anything you will look at. And this is a big rhythm or cycle that you should pay attention to. I'd like to cover one last cycle just for fun. Many of you have heard of the Kondratiev cycle. It's a economic cycle. It covers the major developments and major market crashes or economic crashes that have occurred since the early 1800s. Now, I'm not going to get into great detail here because you can look this stuff on the internet pretty quickly, but it's a cycle nevertheless. And you can see that major developments like railways and electrification and the development of the modern automobile, and of course, the recent development through communications and technology have caused major upswings in both the economy and the markets. In between those cycles are things like the Great Depression, I should say the Long Depression from the late 1800s to around the end of 1800, and the Great Depression, as we know, late 20s to early 1940 area, and the oil and gas crisis during the 74 to 80 period. Some of you might remember that. And even the most recent crisis, which was the financial crisis, 2008, 2009. All of these are considered checks and balances through major developments and major pullbacks. And we are moving into a new environment of biotech and AI and all this kind of stuff that will, on a longer term basis, continue to develop the economies throughout the world. The final type of cycle I want to talk about is a really important one, and it's called intermarket analysis. And I do a lot of this personally. In fact, if you go to my blog at valuetrend.ca, you'll see that I probably refer to intermarket cycles at least once or twice a month through my writings. I like looking at the relationship of certain assets to each other or certain sectors to each other. And I'm going to give you just two right here. If you want to have more information on intermarket analysis, I highly recommend John Murphy's book on intermarket analysis. It's kind of a sophisticated book, so it's not for everybody, but if you want to go deep down the rabbit hole, it's great stuff. And as I said, I rely on this type of analysis regularly to try to get a handle on what's next for the market. This is a relationship right here between Bitcoin and gold. And basically what this is telling us is that when Bitcoin divided by gold reaches a point of about 30 or higher, in other words, the price of Bitcoin is more than 30 times the price of gold, you tend to get into a market peak for Bitcoin and a reversal of the two asset classes' fortunes. That happened recently in 2024. We saw Bitcoin reach about 38 times the price of gold when it hit about 100,000 and gold was trading, I think, at around 2,700 at that point. Well, that relationship immediately started to reverse. The likelihood is going forward, we'll see Bitcoin underperform gold. Doesn't mean it'll crash and burn, but it will probably underperform gold for a period of time. That is a relationship that has been going on, as you can see on the chart, for many years. Now, let's take a look at a really long cycle, and that is the relationship of commodities to the S&P 500. In the 1970s, it was an inflationary environment, and stocks were underperforming commodities as inflation surged. Now, keep in mind, this is a relationship graph. It is not a price graph. So when you see the commodity line moving up in the 1970s, for example, it doesn't mean stocks were going down. All it means is commodities were outperforming stocks. And you'll see this relationship over and over again as commodities underperformed stocks during the 80s and so on. Well, the idea on this chart is that we've recently seen an underperformance by commodities up until about 2020. Some of you might have noticed that since about 2020, commodities have generally been catching a bid. We've seen gold break out. We've seen other commodities start to take interest by the market. So according to the cycle, there's a good chance that commodities will move into another era of outperformance against the stock markets. It does not imply the stock markets will not go up. That's not the point. It's that commodities will start to perform better than they have been if this cycle is correct. This is big picture stuff, folks. You don't set your watch by it, but it's good stuff to keep in the back of your mind if you pay attention to cycles like this. Now I want to talk about market breadth. Now, market breadth, if I were to summarize it in plain English, is participation by the largest group of stocks in an index. So let's take an example. If you've got the S&P 500, which is actually a little over 500 stocks, you want in a bull market for the majority of those stocks to be going up. That's just common sense. It means that there is a healthy advance on the market. However, if you have a situation where the market is only being led by a very small handful of stocks, then you have a problem because it's, I guess you could say, the generals are doing well, but the soldiers aren't doing quite as well. And it's really important for a healthy market to be moving up. Take a look at a human being. If you've got a great set of kidneys, but everything else in your body is not doing too well, you're still not healthy. So a narrow market means less participation, and it may imply a market bubble. And in fact, in 2001 and 2008, breadth led as a leading indicator that the market was operating on too much focus on specific sectors. In 2001, it was all about technology. In 2008, it was all about oil and gas plus the high yield debt market, such as subprime. So wide stock market participation implies healthy internals, just like the patient at the hospital. And we can look at things like how, for example, industrials are doing versus transports to get a relationship on how market breadth looks. So let's talk about that. As you can see on this chart, if we were to compare, for example, and this is just one breadth indicator, by the way, if you want more examples of breadth indicators, please be sure to take my online trading course because I cover this stuff in depth. I cover quite a few breadth indicators. But the basic concepts are when transportations are not doing as well as the industrials, you've got signs of a potential market correction. In fact, I've been doing this, as you know, for 35 years, and I can tell you that almost every time we see a lasting divergence between breadth and I should say between industrials and transportation stocks, you've got a problem. So what we want to see is if the price of transports are moving down while the price of the industrials are going up, that's considered bearish. Now, the opposite is true though, because if you see transports moving up, but the industrials are moving down, a very rare occasion, by the way, I almost have never seen this, then you have actually a bullish setup. Normally, the two should be moving together, and I'm going to show you a chart right now to illustrate that. So this is one of the tenets of Dow theory. It's not the entire Dow theory, but one of the tenets is that the transports should confirm what the industrials are doing, okay? So the red line here is the industrials. The black line is the transports. And what you can see is, generally speaking, they move together, okay? There's a new high here on the industrials, there's a new high here on the transports, and so on. But every once in a while, you get what's called divergence. And funny enough, in late 2024, we started to see a divergence. And that actually led into some correction through December of 24 and into January of 25. So this is a very important concept to keep in mind because if it lasts too long, you could enter into a full bear market rather than just a short-term correction. The Dow theory of transports confirming the move of the industrials is very, very important to watch for both short-term movements and key major market inflections. So it's one of the tools I recommend you keep on your roster. Now, another way of looking at market breadth or wide participation is to match, for example, the S&P 500, which is known as a capital weighted index, meaning that it will push more emphasis on the stocks that have the greatest capitalization. So for example, during much of 2022, 23, 24, and on, we had a very high concentration in technology stocks, specifically the artificial intelligence orientated stocks. Well, that's not necessarily healthy. So one way of looking at how the overall market is doing against a cap weighted index like the S&P is to look at the New York Stock Exchange index itself. So I've marked that here. The New York average is the black line, and the red line is the S&P 500. And what you'll see is once in a while, you'll see the New York index move flat while the S&P index makes a new high, and that almost always leads into, as you can see here, if I zoom in a bit, leads into a market correction on the S&P 500. So you want to make sure the two are moving in tandem. Well, again, in late 2024, we saw that the New York index, there's a low, there's a lower low, whereas the S&P 500 was more or less making an equal low to its prior low. And the S&P 500 returned to its old high, whereas the New York average did not return to its old high in late January. Now, this is roughly when I am recording this screenshot, but this is normally not a good situation, and the market at the time of me recording this has already been fairly choppy through December and January of 25. So again, the idea is not to focus on this particular moment of me recording this particular video, but to understand that if the broader market of the New York Stock Exchange is not performing as well as the S&P 500, you've probably got bad breadth, as they say. You've probably got a market concentration problem. There's too few soldiers leading the charge. I promised at the beginning of this video that I'd give you a very accurate indicator that can help us spot key inflection points on the market ahead of time. Now, this particular indicator is the New York Stock Exchange new highs minus new lows. So it is a breadth indicator. It's telling us how many of that 2,200 stocks or so of the New York Stock Exchange are making new highs versus new lows, or at least minus the lows, and you come up with a net number. What I have found is that when the New York Stock Exchange new high, new low indicator reaches extreme levels, either to the upside or the downside, we can get inflection points on the market. I'm just going to give you a couple examples. I'm going to look at 2007. So you can see here, there's 2007, and you can see this indicator was very, very high, meaning that there was an awful lot of stocks making new highs. Now, please understand, a bull market, you want lots of new highs, but it gets to an extreme. In other words, everybody's piling into the market. So that happened in 2007, and that led into the 08-09 crash. Now, at the same time, eventually, as the new high, new low market moved down with the market, we hit a point where there was not enough stocks making new highs. In fact, an extremely low point on the market. So there was far too many stocks in the New York Stock Exchange not making new highs. In fact, it was overwhelmingly stocks making new lows, and it got to a point where it was showing us that the market was capitulating. You will find this over and over, and in fact, even in 24, we saw there was a brief period of stocks making a lot of new highs before the market started to peel back. 2020, great period where the market was so panicked that almost no stocks were making new highs, on and on. We can look at lots of examples. I'm always looking at this as one of the indicators I pay attention to, but it has been pretty accurate, especially when you start combining it with other traditional momentum indicators and sentiment indicators. I'm a big fan of this indicator, and I do think that if you use it in conjunction with other tools in your kit, you can come up with key inflection points on the market. Okay, well, this video was a big one, wasn't it? We covered a lot of stuff. We talked about seasonal cycles. We talked about the presidential cycle. We talked about intermarket relationships between things like gold and Bitcoin and commodities and the S&P 500. We talked about breadth and comparing the industrials to the transports. And we talked about the New York Stock Exchange versus the S&P 500. Finally, we use breadth to spot key turning points by using the New York Stock Exchange new high versus new low indicator. I hope you got a lot out of this video. And if you want more information, I'd steer you towards my online trading course because there's more detail there. Thanks for watching.